Welcome to a new episode for the series Commodity Supercycle. And today we have a special guest. His name is Rozencwajg. He's located in New York. Right now, he's sitting in Montreal, and we're talking about different topics today. At first, he was an analyst. He's an analyst since 2005. He worked for the very good bank Lehman Brothers. We all know them, but he made a good exit in November 2017 and 2007, sorry. So a couple months before it went down. Since then, he works on commodities and natural resources focus, and is now managing director for Göring and Rozencwajg Associates in New York City. Adam, great to have you.
Thank you so much for having me. Excited to be here.
Yeah, thanks. So before we start, any stories to tell us about your time at Lehman Brothers? Did you see it coming, or tell us something about it?
No. I was very, very young and early in my career, so I didn't. They didn't let me see the light of day, and I had no idea about anything. So
okay, you had no bad feelings. You heard no rumors. Oh, you went short, and then you founded your own company, and you made billions like Michael Burry.
if only. No.
Okay, good. So your firm is focused on commodities, yeah, and we expect a commodity super cycle. So you even calling the chance in energy stocks as a once in a generation opportunity. So why is that?
Well, so I think first and foremost, what's very important to realize is that we've had a terrible bear market in natural resources and commodities, really for 10 years now. Most commodities peaked at between 2011 and 2012 and spent the next 8 to 9 years selling off in price. And typically, natural resources and commodities move in these long cycles. We can see that going all the way back to the beginning of the 20th century. And typically, when commodities become very cheap and undervalued, that becomes a very good time to invest. And the reason for that is you have the value investment. You know, it represents a very attractive price and valuation. But also, during these bear markets, you have almost no capital spending in the natural resource sector. And since most of these assets deplete, you know, mines deplete, oil wells deplete, you constantly have to be reinvesting more money. And so if all of a sudden you have a capital cycle where people stop investing, then the supply gets very tight. And it usually happens about 5 years after. So that's why you get these big cycles. And we think we're on the verge of a major cycle now.
So, but aren't oil, uranium, coal are actually supposed to be dead? You know, in Germany, we believe that there is a renewable energy, the Green Deal, everything. So why bet on these old things?
Well, so let's first start with the idea that we're consuming more and more energy around the world. And that's true both in the developed world, like in Western Europe and North America. And certainly that's true in places like China and India. And in fact, when you look at how much their total energy demand is growing, it's really quite remarkable. We estimate that there's this period in a country's development right in the middle where when the country's very poor, it doesn't consume much energy. And then when it becomes very, very rich, it's very saturated. You know, everyone drives cars and travels, and so there's not a huge amount of growth either. But right in the middle is where you get this very strong period of growth. It looks like an S, and so we call it the S curve. Okay. And we estimate that more people are going through that now than at any point in human history. And so when you look at the total impact on total energy, I'm not saying wind or solar, oil or gas, just total energy, we have never consumed more. It's growing faster than ever. And we think that's going to continue. So then the question becomes, well, how do you break down that energy into the various sources? Are we going to use coal, natural gas, oil, uranium, or renewables? And that's where we develop a little bit of a more critical view on wind and solar. It's not that we don't think carbon's a problem. However, we just don't think that wind and solar are the solutions. And the reason for that basically are that wind and solar are both intermittent. So they need to be backed up. You know, when the sun stops to shine and the wind stops to blow, you need something to smooth that out. And right now, what people are proposing are batteries. But the problem is batteries are extremely, forget expensive, they're expensive also, but they're energy intensive to manufacture. And so if what you're trying to produce is stable energy, and it requires a huge amount of energy to manufacture in the terms of the batteries, then all of a sudden it becomes a very difficult proposition. And I think Germany probably understands that better than most countries do at this point, in the sense that Electricity prices have gone up dramatically. Incidentally, CO2 emissions per capita in Germany are actually not down as much as people would have expected at the beginning, despite the prices having gone up a lot. And I think you guys are probably the first in the world to really be faced with some of the challenges of renewables. So now the question is, how do we go forward? And to us, the two things that meet that criteria, first would be switching from coal to natural gas, and the second would be uranium. And so we like both of those sources of energy, and we like both of those technologies, and we think they both have very, very strong futures.
Yeah, when we look at your portfolio, we see that the biggest chunk is 34% gas and oil, then copper, uranium, agriculture, gold. So yeah.
Maybe let's start with oil, because like more or less a year ago, oil went negative, and I guess most people in Germany thought, oh well, now solar and wind will be the only reliable energies for the future. But since then, oil only keep going up. What's your outlook for oil for the, let's say, for the next decade? Do we go to $100 to $200? What's your feeling right now, or how do you position yourself?
So we're quite bullish on oil prices over the next 10 and 20 years. I think, it's different than a lot of people. I think a lot of people feel that we're perhaps in the last days of oil. We think very differently, and we think that actually for a couple of reasons. First of all, if you just look at total carbon that comes from automobiles, all transportation, so all planes, all boats, things of that nature, you're talking about 9% of total CO2. And based on the most aggressive assumptions, we are only going to get to 50% auto sales, let alone the fleet, just the sales every year, by between 2030 to 2040. From there, it'll take another 10 or 15 years to switch over the whole fleet. So you're talking about between 2040 to 2050. And on our numbers, based on all the additional energy that goes into making the lithium-ion battery in the electric vehicle, and then the lithium-ion battery to help back up the solar and the wind, because if you're burning coal for an electric vehicle, then really what's the point of that? By the time you factor it all in, you're probably saving maybe as little as no incremental CO2. Yes, it's true that you're not burning oil anymore, but you have all these other sources of carbon emitting energy that go into it. Or based on the industry's own assumptions, which are obviously very optimistic, you're saving maybe 30%. So by 2050, you'll save 30% of 9% of CO2. It's not going to move the needle here. What we need to address is we need to address power generation and industry, which each of those is 30% of total CO2. Those can be addressed with things like I mentioned before, but automotive and jet transport, I think we're looking in the wrong place. So that's first. Once we begin to really frame these questions, I think as a society, we're going to say, this just doesn't make sense to push down this path as quickly and as difficult as we are. You look at Norway. Norway right now is up to 50% EV sales. So 1 out of every 2 cars is an EV. Their CO2 per capita is going down like 6, 7, 8%. It's the same as the United States, where there's hardly any electric vehicles, on a total penetration basis. So I think we're going to begin to realize that this is not the right approach. So that's kind of the long-term demand picture. It's very difficult to replace oil because oil is very energy dense. So for things that have to worry about their weight, notably cars and airplanes, there's almost no way that you can realistically begin to get away from that on a big long-term basis. People are talking about moving to electric planes, but the problem with electric planes is I think they have a range now of 50 miles or something like that, because at a certain point, the weight of the battery is too high to allow the plane to take off the ground. Cars are not dissimilar. A Tesla weighs dramatically more than a comparable non-electric car. And it takes more energy to move all of that weight around, and the weight all sits in the battery. So I think on the demand side, we're going to continue to grow our need for energy, our need for transportation. And I think that people have really, really, really underestimated the importance of gasoline and diesel in our future. Even if you're worried about carbon, there's other things we should be focused on. It'll be cheaper, it'll be easier. So that's number one. Number two is the supply side. And over the last decade, the only source of non-OPEC oil supply growth has come from the US shales. And before COVID, before any of this, we argued that the shales were beginning to deplete. And it's a very complex subject for, probably a whole podcast of its own. But we ran some very sophisticated models that tried to look at what was driving the well productivity. So every time you drilled a well, how much oil it produced, what was driving that? And what we realized was that the biggest factor was where you chose to drill the well. So the industry was what we call high grading, picking their best areas and focusing like a laser in on those best areas. The problem is you don't have those to drill anymore. So now these fields are largely developed in their best areas, and you're moving out to worse and worse and worse areas. And as a result of that, even before COVID, the shales stopped growing. And I think that's a big problem. And I think it's an undiscussed risk to markets and to supply going forward. With COVID, what happened was demand, obviously, around the whole world was impacted enormously as everyone stopped moving altogether. As demand fell, inventories swelled because we weren't using all that crude that we had expected. And so companies around the world decided to both stop drilling new wells and shut in their old wells. And that had a very material impact. Inventories started to decline. They actually started to decline very quickly. And today, inventories are lower than they were before COVID even started. So we've worked off all of the COVID impact. And the problem is inventories are not now beginning to grow again. They started declining, and the declines are continuing, and they're getting faster and faster and faster. So I think that we've overshot. We've laid down too many rigs. We're drilling half the number of wells we were drilling before COVID in the United States, even though oil is still above 70 now. In the rest of the non-OPEC world, there's been no major wins there, a little bit in the North Sea and a little bit in Brazil, but declines everywhere else. So really on balance, nothing for the last decade. That's getting worse. You see what happened with Royal Dutch Shell in the Netherlands with their courts coming out and now saying that in order to comply with environmental standards, they're going to have to roll all of their cash into renewable projects. There's not going to be anything left for oil and gas. And in the United States, what's happened, which is very shocking, is a very small new fund based out of the West Coast was able to get 3 board seats on ExxonMobil's board, despite owning 0.02% of the common stock. It's not supposed to happen that way. But the reason they were able to do that is they came out with a mandate calling for Exxon to not invest in any future upstream projects. Exxon outside of Saudi Aramco is the largest oil company in the world, used to be the largest company in the world. And now they're saying you can't invest in the upstream business. What's that going to do to non-OPEC supply? Your only source of growth, the shales, has been disappointing now for 3 years. You're telling all the major companies to not put a single dollar in new supply. I don't care how excited you are about electric vehicles. We're running into a serious problem here over the next decade.
Yeah, but welcome to socialism and planned economies. That's what we are going to see. But actually, when we have the supply shock, then oil will be above $300, $400, $500. Or am I wrong? Or what's your price target if this all plays out? Where will we be?
Well, listen, I think that if you got oil to $300 or $400, that it seems, if nothing else, it would probably put such a damper on economic growth that it would probably come back down. We used to
socialism.
We used to think exactly. We used to think that 75 to 85 made long-term sense in the sense that if everything kind of progressed smoothly, that you probably could over time, particularly if the banks were willing to believe that $85 oil would last for a period of time, and they were willing to lend, and the industry kind of settled down and reached an equilibrium, you would likely be able to supply incremental demand growth for the next several years. However, that now we think is ratcheted significantly higher because of events in the Netherlands and because of events in the United States with Exxon and things of that nature, and because of COVID. So now I think that a longer term equilibrium price is probably 100 to 120. And like you said, just because we thought that the equilibrium price was 75 to 85 last year, that didn't stop oil from going negative. It didn't stop it from going to 20 back in 2016. And so I don't think it'll stop necessarily at 100 or 120. Things tend to overshoot on the upside and overshoot on the downside. But whether I don't think I'd be comfortable with a $300 oil price target.
No, this is a difficult world we're living in then. But what do you think? Is the next lockdown already priced in? Will we see a deflationary bust again, and then oil will be negative again? Or what's your take on this?
Look, I think it's very difficult to try and predict whether or not we go back into global lockdown. My gut feel would be that, even with these variants, we are now out ahead of it in terms of vaccination. And I think from what I've seen, at least in the United States and Canada, and from what I've heard from my colleagues in Europe, I think that widespread lockdowns, there's very little societal appetite for that, particularly if we do have vaccines, which, while not perfect, and while we may get breakthrough variants, are still dramatically lowering the rates of hospitalization and death and things like that. So I don't think we're going back to that world. But look, demand shocks are always the biggest problem when it comes to the oil markets. I think that that's one of the more interesting sides of things. I think Western Europe and North America has to come to terms at some point with the fact that we're all broke in terms of all the governments. I think that will be a fairly large shock at some point as well. Whether that ends up in an inflationary period or a deflationary period is very clearly open for debate right now. The markets think deflation. We tend to think inflation. When you look at the price of real assets over the last 120 years, like I said, they move in these large cycles. We've never been cheaper than we are right now. And that tends to be followed by periods where real asset prices become more expensive. I think when you look at the supply fundamentals, when you look at the capital cycle, that makes a lot of sense. We haven't invested anything in these assets now for a decade. That has to begin to really come to hurt. And so I do think that inflation is coming, and I do think that we're about to enter into a bit of a new regime. We've had from 1980 really until 2020, 40 years of ever lower inflationary expectations. And I think that that's unlikely to continue here going forward. And I think, something that's a little bit, maybe sounds silly, but something that I think is kind of interesting. In the United States, there's a magazine called Business Week, and that magazine is, widely read, maybe less so now than it used to be, but it's very much accessible to the public, and it's not specialist. It's a generalist magazine. It's read by everybody. And in 1979, Bloomberg Business Week wrote a cover called "The Death of Equities," and they made the case for why stocks would be impaired going forward. And stocks have gone up ever since for the 40 years after that. It was the worst call in the history of journalism. And in the late 1990s, the FT wrote a story called "The Death of Gold." They said, gold had gone from 800 to 275, and we don't need this anymore. This is the death of gold. And of course, gold was not only the best performing asset class of the next decade, which my partner Lee correctly predicted back in 1999 in Forbes magazine, but it was also the best performing asset of the next 20 years, from 2000 to 2020. So with that, we do think that there's some power in these magazine article covers. I think it's not magic. What it is it tends to be a reflection of what everyone thinks, what the popular opinion is. And the popular opinion, as we all know, is oftentimes incorrect. Certainly in markets where the popular opinion actually gets priced in. And so, you're paying for that unanimous view. And then it's usually worth taking a bet on the other side. And the reason I bring all this up is that in 2019, there was an article in Bloomberg Business Week saying the death of inflation.
I love this cover. And that was the bottom of inflation.
Bottom, the absolute bottom.
Up.
And I completely agree. And what's interesting, and I remember when the article came out, and we're big fans and followers and colleagues of Jim Grant, who writes Grant's Interest Rate Observer in New York. And we were tweeting back and forth and sending him the pictures, and he was sending us the articles and things like that. And we said, well, this is it. And Lee, my partner Lee, who has been investing since the early 80s, said to me, be careful in all those other cases in 1979 and in 1998 or whenever the FT wrote their thing. Said it's true that was basically the bottom, in the sense that things didn't go much lower. In fact, they didn't go any lower, but performance didn't really pick up for between 2 to 3 years after the article was written. So you kind of had this period for 2 to 3 years where it just kind of moved sideways, or maybe a little bit lower and what have you. But 1979, it really wasn't until 1981 that stocks started to do very well, with gold, bottomed in 99, but it wasn't until 2001 that things started to look good, in 2001, 2002. And so he said, I'll make a prediction. It's going to be the spring of 2022. And he said this back in 2019, that inflation is really going to kick up. And I even went to Zurich last year in 2020 and gave a speech, titled, the coming inflation, what have you. He said, spring of 2022. People said, why'd you pick that? Well, it's 3 years after the magazine was written. Now, it's so funny, but I think that that'll probably be right. People are talking about inflation now, but the market still doesn't think there's any. But I think that that'll quickly come. And I think we're about to enter into a new period where inflation will be back.
And in your opinion, oil or energy stocks in general are one of the best inflation hedges out there. So you keep a plan on keeping a big exposure to energy stocks over this decade, unless something major happens.
Yeah, I think that's right. One thing that I do think is a little bit interesting, it's obviously funny how historical views, I think, impact people and investors and whatever. And obviously. Germany's experience and the United States' experience in the early part of the 20th century were very, very different. One is focused entirely on inflation. The other is focused always on deflation and what have you. And so I get the question all the time, can oil work if we stay deflationary? Everyone thinks we're going to stay deflationary in the United States. And what I tell people, which is kind of interesting, is that, there are 3 very good periods for commodity investing and for oil investing in the 20th century. The first was actually during the Depression. Between 1929 and 1940, oil stocks were actually up, and the broad market was down 50% in the United States. The next was in the 1970s. From 1969 to 1980, oil stocks were up 8-fold, and the only thing that worked. And then from 2000 to 2010, oil stocks did very well, and resources stocks in general did very, very well. Now, were there inflation or deflation? Obviously, during the Depression in the United States anyway, you had a massive period of deflation from 29 to 39. In 1970 to 1980, or 1969 to 1980, that was very much characterized by inflation, at least in the United States. That's our sort of collective period when we think of inflation. And from 2000 to 2010, it was really kind of neither inflationary nor deflationary. But what they all had in common, those 3 periods, was that natural resources were really cheap. They started each of those periods very depressed. And so what I tell people is I think that this cycle will see commodities moving higher. They will see resources moving higher. And I do think that we're entering into an inflationary period, given the amount of money we're printing all around the world. However, strictly speaking, I don't think you need one to have the other. I don't think that one has to be a protection against the other. But I do think in this particular case, we will have both occurring at the same time.
But I guess it's so important to summarize. So you just look back at the past 100 years, and there were only 3 times where commodities were really an interesting investment. So it's really a once in a generation opportunity, because those spots right now, they don't come up too often. And that's, I guess, why you call it, a generation opportunity, and basically bet your whole fund on that. So that makes a lot of sense. And that's why it's also your last book is called The Biggest Chance
of all time. So you agree with us when we say there is the commodity super cycle upon us. Actually, it's already started, but it will last for the next 5, 10, perhaps even longer.
I definitely do. When I look, like I said, if you look at demand, the way demand is setting up, whether you're looking at energy demand or materials demand, we're urbanizing more people in the next 10 years than we ever have before. That both requires a huge amount of material and a huge amount of energy. We're taking people from the poverty line up into a lower middle income type of existence. It's interesting that in that process, it's not a one-for-one move in terms of material and energy. It's a dramatic move, because when you're living a subsistence lifestyle, you're consuming basically nothing. Everything goes towards your survival. And then all that surplus capital, taking you from this level of wealth to this level of wealth, the surplus goes from 0 to this, right? And so you get this kind of levered effect in terms of what you do. And what do? You change your diet. You move into more of a protein-based diet that's extremely energy intensive. It's very grain intensive as well. If you want to eat a certain amount of calories from animal protein, it requires 7 times the amount of grain than if you just ate the grain itself, right? So it's a very energy and grain intensive process. Urbanization requires a huge amount of building materials. And it also, people don't really think about this, it changes the way you consume things. So the whole thing begins to really multiply on itself. And so from a demand perspective, we've never seen anything like this. And if you look at the world's population in that sweet spot of their demand profile, normally it averages about 700 million people. That's been fairly constant for the last 80 or 90 years. We're at 2.5 billion, on our way to 4 billion people going through that right now. It's the step function higher. And that's why demand, every crisis we've had in the last 10 years, demand has come back faster and faster and faster. And it's because you have this new group that just wasn't consuming before. And at the same time, on the supply side of things, we've just neglected this industry. I don't care what it is. I don't care if it's oil and gas. I don't care if it's shipping. I don't care if it's, mining. We just have not put enough money and resources and time into developing our next generation assets. And that's where these markets can really snap, is that you have these timing mismatches. And so you don't realize the impact of doing that until it's too late. And you say, okay, let's turn around. Let's bring on the new copper mines. But they're not available. They're not ready because they haven't been discovered and developed yet. So I do think that we're entering into, super cycle. Some people get scared of that term. I do think that we're going to enter into a period of dramatically different real asset prices, that will see real assets normalize relative to financial assets. And that's going to be very, very dramatic, and it should last for a decade.
Talking about copper. So what is Dr. Copper telling us right now? What's your elevator pitch for copper?
Look, I think that copper right now, what people are beginning to appreciate and realize is that as we electrify, we're going to need a lot of copper. And if you talk to people, when I look at gold stocks, I look at oil stocks, they've all been good performers, but no investors have put any money into gold. No investors have put any money into oil, certainly. If you look at the flows, they've been all negative coming out, even as oil prices have done well. Copper they have. That's the first group in this resources bull market that has actually seen participation from investors. And why is that? Well, I think that the story has been told now that copper is a green metal, that copper has elements that, play nicely with environmental concerns. So this whole pitch that I just have given you about capital spending and demand, if you really are concerned with environmental issues, you might say, yes, I believe everything he's saying, but I still don't want to do it. I'm willing to give up those investment returns because of the environmental angle. But with copper, you can all of a sudden say, okay, now I can sleep well at night. I have all of those great things that Adam just talked about, and I don't have to worry about environmental concerns. Now, whether or not that's 100% true, or whether or not it kind of misses, I think a lot of what might be true about that, you could bridge the case into something like natural gas as well. But people don't want to do that. They're focused right now on copper. Fine. That is what I think has taken copper prices up to a record high thus far this cycle. That's what's taken the stocks up quite nicely. But there's two things that investors are missing today. And I think this is really important for your audience and for investors in general. The first thing that investors are missing is what's coming next with supply. Everyone appreciates demand, but I don't think anyone appreciates supply. And we get questions all the time that says, okay, demand is good, prices are high. When is that new wave of copper coming on? And I said, guys, I think you're going to be really surprised to see it's not coming. And it's going to take much longer. Look, I say it's not coming. There'll be some new mines that come online, yes, but I don't think we're going to disrupt this market with too much supply anytime soon. So that's number one. And when people realize that, I think there's going to be a big panic. Copper prices right now, they bottomed at $1.50 and they're $4.50 today. The last peak was about $4.50. They got up to $4.77 this cycle. I'm sorry for your audience. I'm talking US dollars per pound, which is how we do it here. Typically in a bull market move, you can go from trough to peak of 7 to 10 times. And, when you look at the last peak, it tends to be 4 times higher than the last peak, stuff like that. The last was 450. We made it to 470. That's great. We're at a new high, but this could run much farther than people are giving it credit for. And just to put it in perspective, this is the next thing that I think investors are missing, is how much cash some of these companies stand to generate, even at today's copper prices. And so you take a company like Freeport, Freeport's sort of this bellwether copper company, and just even on their guidance, if you do $5 copper through their models next year and into the year after, it's going to do like $13 or $14 billion in EBITDA, which is, by the way, comparable to Visa, which has a market cap 10 times its size. So we own Freeport. It's a large position of ours, for full disclosure. But I think that people, that's the other question we get: have the names run too far because they're up, a couple 100% off their bottom?
I mean,
they
the
were
Freeport, if I shortly interrupt you, the Freeport chart looks basically like a Bitcoin chart. It just kept going up over the past 12 months. It's crazy. So, but you're saying you're not worried about it being overvalued right now. You think this stock will even go higher over the next?
I think it'll go much higher. Just to put it in perspective, it has a market cap of $50 billion, and Visa has a market cap of, I think, $500 billion. And so I think it does have a lot of room to go. If you look at some of the yields, you're talking about mid-teens cash flow yields on some of these companies, which that's not where bull market tops happen. Bull market tops happen when yields get compressed to almost nothing because investors are willing to invest at any price. That's not where we are now. And what people don't appreciate is how cheap these stocks were. If you have something that went down 90% and then it doubles, you're still down 45%. So, I think that's what people have to realize.
Any other interesting copper stocks besides Freeport you actually are looking at, or you actually want to share with our audience?
Well, I think, one of the more interesting and intriguing names is another name that we own. It's called Ivanhoe Mines. They have a very large deposit in the DRC, the Kamoa-Kakula project. It's incredibly high quality, and they've been developing that very, very well. It's less of a unknown story these days. It's a little bit better appreciated, but we've been on site there, and I think that's a wonderful asset that'll continue to grow and get better. Their market cap today is 11 billion. In some ways, depending on how it grows, you could make the case, it's radically undervalued compared to a name like Freeport. Other ways, though, given that it is a little earlier stage, I think you have to kind of take that into account here as well. So, but I think it's a deposit that's going to grow from here.
Yeah, it's also not in the safest place. So that's, guys, something to keep in mind as well. But I guess something to very important to understand what kind of time frame you have when you invest in those companies.
So we
6 months, 5 years.
We try to take long-term time horizons. So we try to take between 3 and 5 years. We're not scared of looking out over the longer-term time horizon. In fact, we try to use the volatility in the interim to try to at least hold on to positions, and ideally would add to positions. Last year we doubled our oil exposure in April, which I think was obviously very, very good call. And I think that's always been a big advantage of ours. We make very long-term models. In the short term, it's very difficult to predict what'll happen, and we almost don't try. We tend to be early on absolutely everything. So I wish we could figure out a way to be better at that, but we really can't. So we do take a long-term time horizon, and I think that's our advantage. And I appreciate that not everyone can do that, which is why I think it makes it our advantage. But it's not for everybody, but we try to be patient and long-term and deep value.
So you're not worried about if Freeport goes up or down 5% tomorrow. You're actually playing the long game, and in the long run, it probably will 5x, maybe 10x from now. I don't know. But especially in Germany, there's not really a culture in investing in the stock market. So if Freeport goes down 10 or 20% over the next couple of months, people are really worried about it. And I think that's a really important lesson there, that you actually don't care about that, but even see it as an opportunity to buy even more shares.
Summer sale.
Yeah.
Nice discount. Yeah.
Yes, so it's hard, and it's hard to do. I can empathize with your audience. I mean, it's hard for anyone to do, professional or retail. But I think that it really is, something we should be training ourselves to try to be better at, whoever we are.
Yeah, definitely. So let's talk about ESG, green energy revolution. It's all over the place. It's the hot shit in town right now. Even central banks plan to finance it. So I think it will be the next bubble. So what do you think? Is the green revolution real, or is it just a marketing gag?
I think it's mostly a marketing gag, unfortunately. You know, and I say unfortunately because I do think that we have some, you know, carbon problems and issues that we need to address. And so it's the worst of all worlds. It's a real problem and a bad solution. You know, but there you have it. You know, I think that the big problems come from the way we're trying to address carbon. I think the problems come from the technologies that have been put forward. You know, why those technologies have been the ones that have been put forward? Well, probably because it turns out it's extremely difficult to try and operate a rich, abundant life that we're used to without efficient sources of energy. And it's hard to find efficient sources of energy that don't emit carbon. And so we're left with two choices. We're left with emitting carbon and enjoying the fruits of that, which is to say, you know, for every unit of energy you put into an oil ecosystem, you get 30 units of workable energy out the other side. That's incredible. You know, that's allowed for, you know, imagine if every dollar you put into your bank account, you got $30 back at the end of the year, you'd have huge surplus of capital. And in the same way, we have a huge surplus of energy. You know, the more we put into it, the more we get out of it. And that has been true through most of the 20th century. And it's led to an unbelievable rise in living standards around the world and an unbelievable increase in energy intensity per person around the world. Nothing, you know, we've never experienced anything like it. So
yeah, sorry.
No, so I was going to say, so now you have to decide whether or not you would like less carbon, but less energy efficiency, which is less, you know, ability to enjoy the things that we take for granted today. Or do you want to keep going the path that we're going? And to us, there's only one way out of that decision, and it's a very difficult decision. It's a decision that, you know, to be perfectly honest, we're trying to do really well and navigate and use our best intentions in the Western world. But ultimately, it's a question you have to ask people that are living, you know, near subsistence lifestyles in Southeast Asia and Africa, whether or not they're willing to, you know, stop their development today in order for the, you know, benefit of ESG and carbon. And the one path, as far as we're concerned, that gets you away from that choice, something that is low carbon emissions, able to be base load, meaning it doesn't turn off at night, and that's nuclear. And why the environmental groups, you know, have focused so hard as a problem. I mean, look, obviously, you know, you've had 3 Mile Island, Chernobyl, and Fukushima. And in the case of Fukushima, you know, I think the jury is still out, but when you look at the actual, you know, radiation released and death tolls related to radiation at Fukushima, it's quite low. And in fact, you know, I don't think that the background rates of cancer. So here you have this technology that can be developed in a safe way, particularly if a lot of time and effort and capital is put behind it, can definitely be done in a safe way. It is by far the least amount of injuries and death out of any source of power in the world comes from nuclear, much less than coal mining, much less than solar panel installation. More people fall off of roofs installing solar panels than have died in nuclear accidents. And so we need to just have a sensible conversation. And I think it's starting. I think in the United States it's starting. Great Britain it's starting. And the Netherlands we've actually seen proposals now. You know, and France we've seen proposals. Unfortunately, I think largely because of the challenges faced by Germany in dismantling their nuclear fleet over the last 20 years and some of the unintended consequences about that.
Yeah, but I hope this will change with the next government, because this is a historic failure, in my opinion. I wrote a whole chapter actually about uranium and nuclear power in my new book, and I think it's part of the future. If we really want to reach the goals of the Paris Treaty, we need nuclear power. We can't do it with the sun or with wind. So, but well, another thing, you actually predicted the top in the EV stocks for the fourth quarter of 2020. So, what do you think? Is it a bubble? Did this bubble pop? Is Tesla overvalued? What's your take on this?
Yes, I think Tesla's overvalued. I mean, I don't know how you could think that Tesla's not overvalued. I think what's so funny is, if you look at Tesla, it's worth more than the entire auto industry.
Yeah.
So I mean, if you just step back and you say, who cares? Internal combustion or electric vehicle, you would think that the pie is the pie. I don't know how electric can be worth more than all of it pre-Tesla.
Yeah.
So it doesn't really make much sense to me, and it doesn't make any sense to me either. The idea that the other auto companies are not going to compete intensely against Tesla. Tesla cars, first of all, Tesla cars are very expensive. They can't get one that's a mass appeal. Volkswagen seems to be better able to do that than Tesla has been, although Volkswagen is having trouble as well. So no, I think that Tesla is going to be looked back upon as a definite bubble. I think, I know they released results, was it this morning or yesterday? And I actually, I think this was sort of the first quarter where they actually, their results on the surface, at least, were not entirely driven by tax credit trading and Bitcoin trading.
Yeah, exactly. Yeah.
So, the company, I think, is certainly a bubble. And I think more than that, I think it's a misguided approach from investors. And I think it's a symptom of a much bigger issue.
Yeah, this time is different, not. But do you think electric vehicles are the solution, or what do you think about hydrogen?
So the problem with hydrogen, hydrogen has one big benefit and one big drawback. And I think ultimately it's not going to be the solution. And when we say hydrogen, I presume you mean hydrogen for transportation.
Exactly. Yes.
Yeah. So when you have hydrogen for transportation, you don't need a battery. So that's good. You store the hydrogen on the car, and the hydrogen creates the electricity when it works through the fuel cell. And so you don't need the battery. And I said before, remember how difficult batteries are, and mining all the materials for them and producing and manufacturing the batteries are incredibly energy intensive. So you don't have that. Great. The problem is making hydrogen is incredibly energy intensive. We don't mine hydrogen. There's no deposits of naturally formed hydrogen. We have to make hydrogen.
Yeah.
And there's no quick way to do that. You have to you can either take natural gas and create hydrogen by doing that, but that releases CO2. What most people are talking about is the idea of going to what they call green hydrogen, which is you use electricity to take water and separate water into oxygen and hydrogen. That is horribly, horribly, horribly energy intensive. And what most people will say is, well, that doesn't matter because we'll connect it to a windmill or a solar panel. And so it doesn't matter how energy intensive it is because the energy is free. But that energy now, the windmill and the solar panel I told you, is not a very efficient way to create energy. So the entire process is very energy inefficient from start to finish. And what the pushback you'll get will be one of two things. First of all, some people will say, and this is happening more and more and more, which really scares me, and it makes me think that we are living in a bubble time. People will say to me, and I'm talking very sophisticated, consultants and policymakers will say, you're thinking about it wrong. This is what people want, and we're doing it. It doesn't matter if it's efficient or inefficient. Now that to me is a very frightening thing to hear. But the other thing that you'll hear people say is that it doesn't matter if it's inefficient because it's renewable, so it's endless. The wind is endless. But keep in mind, we have never run out of anything. We've never run out of oil. We've never run out of natural gas. Yes, oil's finite, but from our perspective, consuming it, we've never been presented with that finite oil. There's always been more oil. So it's not the question of whether it's renewable or finite that impacts the market. It's whether or not it takes a lot of energy to liberate that energy. And oil is very efficient at doing that. yes, it's finite, but I mean, who cares? We've never run out of oil. We've never felt that finiteness. So just because something is renewable doesn't mean you don't have to then think about anything else. What matters at the end of the day is how efficient it is.
Yeah.
And it's just not. And so with hydrogen, you lose 75% of the energy from the beginning of making the hydrogen to the end. There's no battery. That's very good, but it's very, very.
But do you see any other solution for the future beside oil and electric vehicles? So is there another energy we don't know so far? What do you think? What will be the future of mobility?
I do think, ironically, if you wanted something that could compete with oil, and you looked at how energy efficient nuclear really is, if you wanted to make all of your electricity with nuclear, and then you wanted to waste some of that amazing energy savings by making batteries and running electric vehicles, you could start to get, if you had sort of a closed economy, that's all that they did, you could start to compete with hydrocarbon-based vehicles. So, that could be down the line. What I think ultimately, though, I think that if you look at, like I said, all of personal transportation is 9% of carbon, steel is 9% of carbon. It's much easier to develop a new steel process that could be done in a low carbon way than it is to replace every automobile on the planet. So I don't know why we're not starting with the easy things like that. There are companies that are doing it now that I think are fantastic. They're earlier stage and private, but some of them have very, very good results. I also think, cleaning up the power sector, which is 30% of CO2 emissions, would be much easier than trying to go down the path of trying to change out automobiles and planes, which, like I said, in total, 9% of global CO2. So basically what I think is that I think that gasoline and diesel for use in personal transportation should probably be the last carbon that we emit on the planet. And if we can get all the rest of the carbon down, 90%, I think we'll be in great shape. And then we can, deal with that last bit. And it's not because I want to think that, and it's not because we're invested that way that I think that. It's because in the uses that I just told you, you have a density issue, which means you have to worry about your energy content and your weight. And oil is very energy dense. And so there's very, very difficult to get around that. And these other things, we don't need energy density. It doesn't matter, whether or not, weight has nothing to do with when we manufacture steel. The steel plant just sits there. We need to look at the other considerations. But when you have to deal with weight, it becomes very, very challenging and very tricky to try to get over that. And that's what we have to deal with personal transportation. And that's why oil is a very unique property today.
So I guess to summarize, it's not a green revolution, but a commodity revolution. So that's a true revolution here. And I guess that's why you are so long commodities, because that's the main thing that's necessary here to reach those goals. But we want to talk quickly about two other commodities, and maybe one even more important than energy, agriculture and food. And food prices, agriculture prices have been also on a tier over the past couple of months. What's your current outlook there? Because if food prices keep going up, energy prices keep going up, that's going to be huge drivers for inflation.
Social unrest, actually.
And social unrest as well.
Yes. Absolutely. And so I think that what's happening in the grain markets is actually quite important, as you just said. When you look over the last 5 or 10 years, even, global grain demand has been very, very strong, extremely strong. But supply has been very strong too. And we've had these almost perfect growing conditions, not just in the United States, but it's been the United States and Brazil and the Ukraine. And it's sort of been like, every year when you look at the numbers, you say, okay, here's what demand trends are. Here's what we need to meet that demand. What's the likelihood of getting that? And every year you say, well, it has to be just perfect this year in order to get it. But it has been. And our yields have been very, very, very strong. We've set record yield after record. What's so fascinating is that last year in 2020, we started the year with a good amount of grain in inventory. Demand was again projected to be very, very strong. And midway through the summer in the United States, we had some bad growing conditions, and they weren't fully appreciated by the USDA, which is the United States Department of Agriculture, who releases all the data. They didn't fully incorporate them. So into September, they were predicting that the inventory levels for grains would stay at record high levels or near record high levels, and very, very bad for grain prices. And we had a lot of excess supply. Within 6 weeks, they revised that all away. And within 6 months, they were now saying that actually inventories were at almost a dangerously low level. So that's what has really, pushed prices higher. So now we enter this year into a different situation than we've had any time in the last 10 years. Demand is still strong. Supply will be what it's going to be, but we're starting from a fairly low point in inventories. And so unless we get very good growing conditions again and very good yields, and I'm talking about near record yields, we're going to have a situation where inventories get dangerously low and prices are prone to spiking higher at that point.
So are you worried about food security and social unrest if that plays out?
I think the grain prices could definitely go higher, and I think that food security is shaping up to potentially be an issue. Social unrest is obviously very difficult to try and forecast. It tends to happen, when you least expect it, and in a sort of chaotic type of a way. But yes, I think certainly the risk here is that food security could be a problem as we go through the year. We'll have some more data here. We're right in the middle of the growing condition season in the U.S. We have dry conditions through a lot of the Corn Belt and drought conditions in the far west. Now, the far west is not as important for grain as the Midwest is, but it strikes me as very unlikely that we'll get record high yields this year based on how dry it's been in the United States.
How do you go about investing in agriculture? When you invest in copper or oil, it's pretty straightforward or easy. Look for the best copper mines and then invest into those. With agriculture, it's not that simple. Do you invest in future contracts? Do you invest in any certain type of business? How you go about that?
So we tend to invest in fertilizer companies. There's different people try to do it differently. You can invest in water companies. Some people do that. Others can invest in the futures. We prefer, and we have for a long time, to invest in the fertilizer companies and some of the seed companies as well. And those tend to respond very well when farmers' incomes go up. They spend more money on fertilizer quite quickly. And so there tends to be a nice connection there. And they've represented very good value. Like all the other commodity stocks, they've been out of favor for a long time, and they have good value to moves higher in the commodity prices.
Any names for the audience to
Name
think
dropping.
about?
Oh, so first of all, I would say, we do have a website, and in the website, we do list our publicly disclosed holdings. Yeah. We do run a mutual fund in the United States. So some of our stuff is publicly disclosed.
Yeah, we put a link below the video, of course. Yes.
Okay, excellent. But, as far as our names go, I would say we're a little bit less differentiated in terms of our agricultural names. I don't think that we're looking for the best undiscovered potash names here, because the industry's been so out of favor and represents deep value really amongst the big players as well. We tend to divide our investments amongst the sort of common names, which are Mosaic, CF, Nutrien, things like that.
Yeah, I saw it in your top positions. Yeah, they're all in there. So let's switch to another very important commodity, of course, gold, silver, platinum. What's your take on this? Do you plan actually to increase your position on precious metals?
At some point we do, yeah. I think given all the money that's being printed around the world and all the asset bubbles that we see, I think that gold is going to do very, very well in the intermediate term. However, as you guys, and I'm sure your listeners and viewers know, gold's a little different than the other commodities because it's not consumed. It's just held by different people. And so it switches hands all the time. And so I think what becomes important is to look at, how price sensitive are the buyers and how price sensitive are the sellers. And if you look at the gold market that way, you do get some very big trends. Like in the 1990s, central banks were selling their gold. They were not price sensitive. They wanted out. They were selling their gold. Didn't matter what the price was. Eastern buyers tend to be very price sensitive. So in Asia, in China, and in India, what you tend to get or you tend to get buyers that, have a long cultural affinity and history for precious metals, and they have a very good sense as to when gold and silver appear cheap, and they step in and they buy. And that really drove the market higher through most of the 2000s, right? So if you look at Western investor demand and you look at Eastern investor demand, almost all of the demand came from Eastern buyers. So that bull market was actually moved up quite steady. We think that this next bull market will ultimately come from Western investors, which are much more speculative. Again, kind of like Bitcoin or Tesla or what have you. I don't think anyone that likes Bitcoin talks about valuation. They buy it, they want it. The higher it goes, the more they want it in many, many cases. And so we think that ultimately this bull market will have a lot of Western involvement in it, and that'll help push prices materially higher. That plus all the excess credit that's been created around the world, it's like a tinder box ready to be set on fire. However, for right now, what you have is selling amongst the Western speculators, liquidation of gold that was accumulated in the last 18 months, and you have selling by the central banks, whereas you had buying for the last 15 years or so. And so both of those investors, or both of those groups of people, tend to be a little less price sensitive. And I think that will put further upward pressure, or downward pressure rather, on precious metals prices. So that's what we've been seeing. Pardon me. That's what we've been seeing for the last, year, or 9 months, 12, 10 months, what have you. And I think that's going to continue until we start to see the Western selling stop, and until the central banks turn back into net buyers. And I think the reason the central banks, have been selling is that COVID has been very difficult on their finances. And so I think certainly the idea of being able to put excess money into gold buying has not been top of mind in places like Russia and Turkey, which were big gold buyers over the last 10 years. So I think that'll come back. But I think so long as they're selling, and so long as the GLD, which is Western, is shedding, I think that's going to put pressure on gold prices to move higher.
What actually about silver? Because silver is also not only a precious metal, or not only as store of value, but also as a high industrial use, especially also in the green revolution. So do you have a different view on silver than gold, or do you put them in the same bucket?
Well, in some ways a little different, in some ways the same bucket. I think that in the bull market and gold that's coming up, I think silver will do very, very well. You've never had a gold bull market that hasn't had a silver bull market associated, even led by silver in most cases. And I think that given, like you said, some of the industrial and green energy aspects to it, I think that there'll be a nice tailwind there as well. Unfortunately, I think for most of your viewers, the catch up in silver relative to gold was what happened last year. There had been a huge discrepancy between the ratio of silver to gold. Silver was very undervalued relative to gold, and it caught up quite dramatically. Actually, what that usually means when that happens is that both silver and gold prices tend to move sideways for a period of time after. No real reason for that. That's just the pattern historically. And so I think that silver probably trades sideways here as well with gold, but then as gold begins to do better in the decade to come, I think silver definitely will do well too.
What's your price target for gold and silver in this cycle?
Well, I think our price target, my partner Lee, when gold was $250 an ounce in 2000, he made the prediction that gold would reach 2,500. And the reason he said that, it was 2000 or 2,500, I can't remember now. I have to go back and look. I think it was 2,500. And the reason he did that is he did a ratio of the Federal Reserve's monetary base to the value of its gold holdings. Look, people might ask, well, what does that really mean? What it is it's an attempt to try to value the value of gold relative to the value of financial assets. And it turns out that over time, there's a very clear relationship between those two. It moves in a band. It gets cheap and expensive. And so that would have been the price target needed if gold went from being cheap to expensive. And if you do that math today, you're well over $10,000 an ounce.
Okay,
so
that would be silver then.
Yes, exactly. And then silver, you take the long-term ratio of silver, and that would probably make it at what? Do the math here. Hang on.
500?
Yeah, something like that.
Something like that.
Probably if you go for 15 to 1, 20 to 1, you
That's
end
crazy.
up for crazy prices for silver.
This would
Yeah,
be
so,
interesting
but
world
I
we're
think-
living in then.
I think people have time. I think people have time. But you know, you just said what a crazy world it would be living in then. You know, you would have said the same thing in 2000 if you said, well, in 10 years gold will be $2,000.
Yeah.
You said, oh my God, everyone would be walking around. You know, it'd be the end of the world.
Nothing
And
changed.
it wasn't at all. You know,
right.
and
Yeah.
and it's funny how things like that can happen.
Okay, so you any stock picks around silver or gold mines you have in mind?
No, we'll stay away from that for right now. We don't have we have a few names. We've been lessening our gold and silver positions to try to fund some of our other investments. We took it from about 15% of the fund down to about 4% of the fund right now.
Okay.
So I don't. I have to be careful to recommend a name that we might turn around and begin to sell and use its proceeds for something else. So if we're until we start to build there. I'll stay away from recommending gold stocks.
So
there's lots of people that do that.
Yeah. So actually, what's the bear case? So what would have to happen that your whole mindset will change 180 degrees? So what's the bear case for the commodity super cycle?
Well, I think for the commodity super cycle as a whole, on the supply side, I really don't think there's a lot that can change in the near term. And so I think the thing that could really derail things would be demand. So if we had a major coordinated economic collapse, then obviously that wouldn't be good for commodity demand. How we respond to that as a society, we seem to be in the printing more money path, which tends to lead ultimately to inflation. However, if you had a major economic shock, I think that would be very difficult for commodity demand, and it wouldn't be good. Now, how do you prepare for that? And the question is, once you do have that shock, is it worth then buying everything? We sort of had that shock in 2020 with COVID, and that was the time to buy everything. And so how could you predict that in advance? It's very difficult. But I think demand is always the risk. I think on supply for oil, some people are concerned about OPEC, and obviously, the oil markets have always operated with a certain degree of spare capacity, which means that OPEC has always had the ability to dial up its production a little bit. Now, that was true for the 7 years where oil was above 100. That was true when oil was 145. That's all. It was true in the 1970s. It's always been true. But today, people seem fixated on the idea, well, what if OPEC decided to put all of its production back into the market tomorrow? That's always would be the case. If that happened, it wouldn't be good. Now, ironically, if you look in the medium term, given what's happening in countries like the United States and Europe from supply, I think within a year or two, we probably would be absorbed. But if OPEC were to fall apart tomorrow, or if OPEC were to put barrels back in before COVID demand came back, that could be a risk. Obviously, other than that, I think it's mostly demand.
Okay. Cool. So let's finish up with some rapid fire questions. So what is, in your opinion, the best energy commodity in the next years? Is it oil? Is it gas? Is it coal, uranium?
If you had to pick one.
I think the best performing energy asset in the next couple of years will be oil.
Okay, cool. So what's the best asset for the next years?
In just 1 year?
No, in the next years.
Next 5 years.
Which was the best asset for the next years? Yeah, 5
Bitcoin,
years.
across everything. So that's interesting. So I'm gonna cheat a little bit. I'm gonna give you two answers. I think when you look at the price of oil assets, they have the highest to run. I think if you look at all of the potential outcomes in the world, all the different uncertainties, copper does best under the most number of uncertain paths. So I think like the highest probability of something to do well in the next 5 years is copper. But I think if our base case, which we have a high degree of confidence in, plays out, then I think oil will be the best performer.
He's a real oil bull. Oh, yeah. Okay, he's from Canada. So.
The German government hates him.
Yeah, I know. Okay, you go.
Most important book you ever read? Don't have to be about investing in general. Any recommendations?
I really like all of Vaclav Smil's books. He's a professor in Canada at the University of Manitoba, but he was made famous by Bill Gates, who says that, he informs a lot of his decisions around energy policy and things like that. It might be a little dry for people that aren't interested in energy, but he's absolutely fascinating. He wrote a book called Energy and Civilization. That's probably amongst the best books I've ever read. And I also really like Niall Ferguson's The Ascent of Money for people that are interested
that's
in
a good one.
things like that.
Any thoughts on Bitcoin? 3 sentences. Do you own Bitcoin? What are your take?
No, I think Bitcoin goes away.
Oh, okay. Good. We have to talk about this in another interview. So last question, it has nothing to do with finance, commodities, or oil. So you're disappointed already. But what is for Adam Rozencwajg, what is the meaning of life for you?
Well, I have two young daughters, so I think that's really changed me over the last couple of years. I have my eldest will be 3 on Monday, and we have a 7-month-old. And so for me, beginning to see the world through their eyes has really been the highlight of the last 5 years, even more than the commodity markets.
Beautiful, beautiful set. Okay, perfect. Regards to your daughter on Monday from Germany. Adam, it was a pleasure having you on the show. I hope we talk soon again, and we will definitely put all the links beneath the video. And yeah, thank you very much for your time and picking your brain. Thanks a lot.
Wonderful. Thank you, guys.